So we're going to give it a couple of minutes, let other people join if they're going to. We're going to talk about a trade in the SPY, the short out of the money put. We got a couple of questions, and what we're going to do is I'm going to go over just the basics, the way I understand it and the way I trade this. This is an open mic, so anybody could just unmute themselves and ask questions, because I'm pretty sure there are going to be some things that I'm going to miss, and maybe some things that I think that's clear and isn't clear for others. So you're able to ask questions. And then what I'll do is I will clean up the video, or maybe I'll just write down some of the most important parts about this trade and make it into a short presentation covering all of the things that we're going to talk about, and post this onto the website, where at any time in the future, if anybody isn't clear, or if anybody just wants to kind of look at the video and understand the basics and what we're trying to accomplish, it's going to be pretty clear. Yes. Gabe says, be prepared to, anybody sings? You guys can sing. I know some guys play different instruments. Gabe plays, what do you play, keyboard?
Yes, keyboard.
Keyboard. We got a drummer in the house.
Yeah, Rod, right?
Yeah.
Rob.
Right, let's.
We couldn't hear you.
I got a shaky connection here. I said, bring it, let's go. Have drums, we'll travel.
All right. All right, so let's talk about, first I'm going to show you guys, this is what I currently have going on. So I keep track of all trades in optionet Explorer. Kind of helps me put it all in one place, keep track of prices, also keeps track of running P&L, and also helps me visualize where my potential risk is. And also I'm able to see all of my positions all on one screen. So I made a couple of notes here, things that I want to talk about. One of the first things being the duration of this trade. We can look at this trade on different time frames, right? So my goal is to open a position somewhere between 80 days to expiration, and I would continue to add to this campaign all the way down to about 45 days to expiration. When 45 days to expiration starts to run below 45 DTE, I look for the next monthly expiration cycle, which is going to be somewhere around 80 DTE. So once we get down to, let's say, current month runs down to about 45 DTE, I go to the following monthly expiration. So in this example here, I have been selling out of the money puts in SPY. Right now, the bulk of my positions are in October 21st expiration, which is currently 63 DTE. When this 63 DTE gets down to about 45, I will start to look to add positions in November monthly expiration cycle. I don't like to go necessarily in the weeklies. I try to stay with the monthlies. I think that's enough for, at least for what I'm doing. Can you use weeklies? Yes. But one of the main reasons why I like to stay somewhere between 80 and 45 DTE is because, for example, if I was to sell an out of the money put today, and I'm looking at, let's say, the 42 DTE, right? Let's compare 42 DTE to 63 DTE. If I'm looking to sell a put and I'm looking to collect about, let's say, $1.30, right? So in the 42 DTE, for me to collect $1.30, I would have to be somewhere around 375 put, right? So, whoops, sorry. So $1.30 will take me down to about 367 on SPY with 42 DTE. If I'm looking for the same 130 credit with 63 DTE, I go all the way out to about 345, 346. Right. So with more time until expiration, I get to go further out of the money. The closer we get to expiration, the closer at the money I will have to set up my short puts. The way it works out is that the puts that I'm selling, I get questions about what is the target delta. I don't look at delta. I look at what I'm looking to collect, right? So my goal is to collect somewhere between, I have it at $1.25 to $1.50. So somewhere in between $1.25 and $1.50. That's my target credit. It just so happens that $1.25 to $1.50 credit works out to be around 5 delta. Right. So let's look at 42 DTE, right? So $1.30 is about a 7 delta right now. And if we look at 63 DTE for the same $1.30 credit, right, that would be 345 put, and this is currently a 5 delta put. So I sell these out of the money puts on Mondays, Wednesdays, and Fridays. One of the questions I've gotten before is, why don't I do it every day? Doing it every day will, number one, will give me way too many short puts than I want to hold. And in the market where we don't see a lot of movement, I'm just going to end up, putting on a lot of very similar positions. Like if I sold a 350 put on a Monday, and on Tuesday we have, a 5 or 10 point move on the S&P, the next put with the same credit will be maybe 1 strike lower, or maybe even going to be the same strike. So I don't want to pile on same strikes. So I try to space them out. For right now, what works for me is a Monday, Wednesday, Friday. If we get a lot of movement, or if I think that I'm holding too few of positions, I can add something on a Tuesday and add something on a Wednesday and then go on a Thursday. But for right now, my standard entries are Mondays, Wednesdays, and Fridays. So let's see if I can write something on here. I'm going to use this. Let me know if you can see the notes. So the duration of this trade is 80 to 45 DTE. Okay. Then we have entry. We'll go Mondays, Wednesdays, and Fridays. Can you guys see that? All right, notes are good. So entries are Mondays, Wednesdays, and Fridays. Target credit is $1.25 to $1.50. I'm going to also make a note here that delta works out to be around 5. Now, the only difference, right? So I got questions about if implied volatility is going to go from 20 to 30, do I still go out the same distance? The answer to that question is it's not about the distance, how far I go out of the money. I always look for $1.25 to $1.50 credit, and that is my target. So when IV is high, right, I'm going to make a note here. When IV is high, relatively speaking, right? 30 could be high, 30 can be low if, average volatility in the last 3 months was somewhere between 50 and 80, 30 is low. But if volatility is, between 18 and 30, 30 be on the higher end of that range. So when volatility is high, we get to sell farther out of the money. And when IV is low, we get to sell closer at the money. All right. So now let's talk about the plan for this trade, right? So every Monday, Wednesday, and Friday, I sell a out of the money put, looking for $1.50 to $1.25 to $1.50 credit. And I do that from 80 DTE down to about 45 DTE. When current cycle is less than 45 DTE, I move on to the next monthly cycle, which is going to be around 80 DTE. Let's talk about the plan for the trade. Before we get to the plan, let's talk about margin, right? And this is probably one of the biggest questions regarding this campaign is, can I do it in a Reg T margin account, or do I need to have a portfolio margin? So this trade could be done in a regular margin account, which is Reg T. This trade works much better, or you get a little more capital efficiency doing this trade in a portfolio margin account. With Reg T margin, I believe if I was to sell, let's say today, if I was looking to sell a 345 put, I think that buying power requirement will be somewhere around $3,500. Can anybody confirm that? If I was to sell a, if I was to sell a 345 put with 63 DTE, I think that Reg T portfolio will be about $3,500. Hang on one second. I'm gonna take a look at selling the same put in October 21st, and requirement for this trade is going to be much lower. The 345 in October I'm showing in the portfolio margin account selling a 345. I already have a 345. Let's look at let's look at a 348, right? 348 is currently going for about $1.37 credit. So if I was to sell a and I'm only for some reason I'm only showing buying power requirement of $10 in the portfolio margin account. I'm not sure if this is wrong, but typically requirement for this in the portfolio margin account. So Eddie's saying $3,450 in the Reg T account. In the portfolio margin account, requirement could be somewhere between $500 to maybe $1,000. And if implied volatility explodes higher, an entry could require somewhere about maybe 1,500, maybe 1,800 per put. So it's still about half of what Reg T margin account requires. So simple answer to do I need to have a portfolio margin account to do this trade? No, you just need a little bit more buying power allocation to carry a campaign that's going to, potentially have between 12 to maybe 15 positions at a time. So based on what I have been doing, and I have done this campaign for, I think I'm running this, let me just double check. I've been doing this campaign starting October of last year. And the maximum number of positions I had at any given time was somewhere just under 20, right? It could go to as high as 20 positions at a time. So you got to think about if you are going to carry 20 positions, and let's say they all require about, $3,500 of margin, that's $70,000 that you need to have as planned buying power to carry up to 20 positions. Another question I get is, can this be done as a put credit spread? It can, but that changes the metrics and entry and exits. But sure, you can go out of the money, sell a put credit spread. And again, the goal is to collect an X amount of max potential profit and get out. So, and I'm going to touch on profit target and a stop loss in just a minute. So maybe we could go back to potentially selling a put credit spread and what that target and a profit target and a stop loss would look like. Let me get back to, where's my, so the plan is collect 80% of max potential profit and get out. That's number one, right? So if I'm selling something for, let's say, if I sold a put for $1, let's call it $1.25, right? 80% of that is $1. So if I sold it for $1.25, I want to buy it back for about 25 cents. If I sold it for $1.50, 80% of that is $1.20. So if I sold something for $1.50, I'm going to try to buy it back for 30 cents. Right. From $1.25 entry, collect $1 and get out. Question I get, can I hold to expiration? You can, right? Do you want to? I don't think it makes sense, and I'll tell you why. So based on what I have done since October of last year, and this is something that Tom asked me earlier today. So I close at 80% of max potential profit. And if you look at how many days do I stay in the trade to reach 80% of max potential profit, that number is right around 50%. So if in the, so let's say my average days to expiration is about 60, right? So in 60 days, that's my average days to expiration at entry. So out of those 60 days, in the first 30 days, I'm able to collect 80% of my max potential profit. The question is, do I want to hold for another 30 days to collect the remaining 20% of max potential profit? To me, I don't think it makes sense. I think you get a you can turn over a little more trades with the same buying power, and potentially over a long period of time, you can generate a little bit more income by closing out early, right? Close out at 80% of max potential profit in a 50% of the DTE, and just keep on reusing the same buying power over and over to generate more income. But to answer the question, can I hold it until expiration? The answer is yes, you can. So the goal is to capture 80% of max potential profit as soon as possible and get out of the trade. And that's profit target. So let's talk about a stop loss. Now, I have run this trade from October of last year. I used, and this is when the market was rallying, we were near the highs. So my stop was set at 3x credit. So if I collected, let's say, $1.25, right? I'm willing to lose 3 times $1.25, which means that if I collect $1.25, I'm going to close the trade at around $5, right? So if $5 minus $1.25, my potential loss is $3.75. 375 is 3 times 125. I hope that makes sense. And this is probably a bit confusing for some, where you know, a lot of people think that if we sold something for $1.25, 3x loss, right? So they just multiply $1.25 by 3, which gives you 375. But if I sold something for $1.25 and I bought it back for 375, I didn't lose 3 times initial credit. I only lost 2 times initial credit. So if I bought it for if I sold something for $1.25 and I bought it back for 375, the difference between the two is 250. 250 divided by $1.25 is 2. So the easiest way to do it is, think about it like this: whatever you sold a put for, if you're willing to risk 3 times credit, you just multiply your credit by 4. So $1.25 times 4, we get a $5 debit. So if I sold it for $1.25, my stop loss is a $5 debit. If I sold something for $1.20 times 4, my stop is $4.80. Right? So $4.80 debit, that's my exit. So stop, 3x credit, $1.25 multiplied by 4 equals 5 debit. So that was my stop loss plan earlier in this trade. But there comes a point in time where, the market could only go down so much until it starts to make sense if you have room for it in your portfolio where you would consider taking assignment. This is not a recommendation. I don't know where the market is going. Neither do you, nor does anybody else that you might listen to. But you have to kind of think about, if you started a campaign when the market was at 4,700 on the S&P, and now we're at, 3,700. So the market's down 1,000 points. We're down 25% or so. Can we go down another 1,000 points? We can. Would you own spiders at 370 where it was at 470 a couple of months ago? To me, it makes sense, right? And my goal is, if I do take assignment, I would sell covered calls above my cost basis to work my way or wheel my way out of the trade, right? So I'm not going to hold it for the next 10 years. If I get assigned, my plan is to sell covered calls against long shares and get my buying power back in a way of getting called out of my position, right? So again, this is not a standard. This isn't for everyone. If you don't want anything to do with spiders when it goes down, 5%, 10%, 20%, then just use a stop loss at a whatever multiple, 3x, 2x, 5x. It doesn't matter. It's just completely up to you, right? So this is where you have to use discretion. Use a stop loss if you don't want to get assigned. If you are willing to get assigned, then you could potentially take the stock and sell covered calls against it to wheel your way out of it. One question I got before was, when do you take assignment and when do you not take assignment? So if I started a campaign and the market went down, say 7% in 3 weeks, right? Now I want to kind of look at things from a perspective, where do I think, what's happening in the market? Where do I think the market may go next? If we're kind of in the middle of nowhere and I feel like there's more downside, maybe I won't plan for assignment and I'll just use a stop loss and get out. But if we're, at a point where market is stretched to the downside, and we can look at a number of different indicators that would potentially signal when things are getting a little too crazy. At that point, I would say, all right, I am willing to, take assignment and at whatever level, it could be, so if spiders right now is at 425, let's say today, I'm going to sell something in October and I'm selling, let's say a 340 put or a 345 put. I need to plan ahead of time, right? If we get to 345, will I take assignment or will I use a stop loss? But you kind of don't want to leave that decision to last minute, because I promise you, when we get to 345, it's not going to feel good. Odds are you're not going to make a good decision. So you kind of want to have an idea, like if we get to 345 in the next 30 days, what do I do? Do I stop or do I take assignment? And if I take assignment, what's my plan? Am I going to hold the shares? Am I going to sell calls against it? What do I do with it? So all of that needs to be thought about before you take the trade, and you have to plan for it. You have to know, how much buying power it'll take to hold shares if you're going to take assignment. If you're tight on buying power, then maybe taking assignment is not what you want to do. But you kind of want to plan for all these things ahead of time, because when the market starts going and we get to 345, and we can get to 345, and you can have like 40 days until expiration. Doesn't mean you're taking assignment 40 days before this option expires, but you kind of want to have an idea of what you're going to do with it. So in my notes, I'm going to make You know what? So either we stop or we get long stock and potentially sell covered calls to wheel out. Since I started to do this trade in October of last year, I've run into several stops. I was just not willing to take stock at higher prices, only because the market was pretty stretched to the upside, right? And we just started to kind of come down a little bit. We were down maybe 10% or maybe a little less off all-time highs. And the market was kind of getting a little heavy, and I just didn't think that getting assigned was something I was willing to do. I was willing to own shares at a lower price. So instead of getting assigned, I had a couple of positions get stopped out. And I just continue with my regular entry Mondays, Wednesdays, and Fridays. And you know, when you hit a stop, you hit a stop that's part of your plan, and you can't deviate from that, or at least you shouldn't. You know, one question I get is, can we roll out in time? So the answer is you can, as long as it's part of your plan, then you can do whatever you want. I don't think rolling out in time makes sense because, again, if I reach my stop loss, right, and I'm now, instead of stopping out of the trade, I'm going to buy to close and sell to open something else. Well, I do that already anyways, right? I'm going to buy to close the option at my stop loss, and the following Monday, Wednesday, or Friday, I'm going to sell another option. So am I rolling that specific option? No, but I'm going to get new trades on as I get stopped out of some of the trades that get in trouble. I hope that makes sense too. Let's see what else we got. I think this is all I had for my notes. I'm trying to think if there's something else that I might have missed. Let me see if I can. Let me see if, like, what do we have for questions, if there are any. So Tom King says, very similar to MES 60 DTE trades, and take them off at 30 DTE. Yes, and if you look at the numbers, you're probably hitting very similar, if not the same numbers. If you look at the percentage of max potential profit that you're able to, or capture rate, if you will, at 30 days in the trade, right? So whatever your entry was at 60 DTE, when you get to 30, how much of the max potential profit do you capture? You should be somewhere about 70 to 80%. And if you're selling puts that are closer at the money, you might be able to get higher capture rate, but I think that you should be somewhere in the neighborhood of about 70 to 80%. Eddie says, so in the Reg T account, this would be about 2.8% ROI per month for profitable positions. What is the net ROI, including stops? It's kind of hard to think about ROI because, again, if you're doing this in a portfolio margin account, you know, what's your risk, right? Do you look at the notional value of all your positions as your risk? Because that's what's really at risk. Even though SPY is probably not going to zero all at once, right? But what is your risk? Is your buying power that's currently required the risk? I don't think it is, because that number could expand. So we don't really know, right? So the risk is one variable that isn't constant, right? It's a dynamic number, which is the reason why it's kind of hard to understand what the risk is. Now, if you're going to, you know, use notional value of all of your positions, then that number, your ROI number is going to be really low. But if I look at my buying power that was required since the beginning of this campaign, I don't think that buying power in a portfolio margin account was ever higher than maybe 30,000. So can I use 30,000? If I use that number, my returns are going to be a much higher in the percentages terms than if you were to use, let's say, notional value of all of the contracts that you may be holding. So it's kind of hard to, and I understand where you might be going with this question, right? If you could make 2.8% per month, how do you scale this to make it a trade that's going to be, yielding 40% a year or something like that? But it doesn't really work that way. You can also look at it just from capital gains in absolute terms, I guess. So if you run this trade for 3 months or 6 months, and you see that in 6 months you were able to generate X amount of dollars, if you want to scale that up a little bit, as long as your buying power allows for it, then you can do it that way. But I don't know if there's a one right or wrong way to calculate ROI for something where you're using a portfolio margin, which requires a lot less than what's really at risk. So Rob is asking, what is the success rate? So based on hang on one second. So based on the last 125 trades, we had 115 trades closed, and we have 10 trades that are currently open. So we have 107 wins, 8 losses, a total running P&L for all those trades is just about 7,000. Win rate is at 93%. But then again, I have not used any stops since last time I got stopped on this was back in January, right? I was willing, once the market started to roll after January, I've gotten once to a point where I was willing to take assignment at 390, and SPY closed at like 390. I think it was slightly below 390 on the Friday at the close, but then in the after hours trading, I guess it went to 390.60, and for whatever reason the broker had never assigned shares. So as far as success rate, it is showing a pretty high number, 93%, but that's because I have not stopped out of any of the trades since the beginning of this year. Right. And so the expected return is pretty good. It, in dollars, it's not a lot, but if you think about it, like I said, if between all the positions that I've had, right, and right now I'm holding 10 short SPY puts, and I don't know if this is right, but for some reason, between 10 positions, I'm showing buying power reduction $71. But I think that on a 10 position portfolio of these short puts, the margin normally is somewhere around between 6 and 8,000. And at a point where the market was selling off, right? So I kept on selling Mondays, Wednesdays, and Fridays without closing any positions, because those positions that were open, they would increase in value. So I was getting further and further away from closing out those positions at my profit target. So I just ended up accumulating more and more positions. And I believe at one point I had something like 18 positions open at once, and buying power required for that was under 30,000. And that was when IV had expanded, and I think the VIX was somewhere in maybe low 30s. So if you think about it, in the last, so since October of last year, right, it hasn't been a year yet. Right now, running P&L is somewhere around 7,000, and let's say my risk, if you will, was $30,000. You divide 7,000 over 30,000. It's about a 23% return on buying power that was tied up to generate that 7,000. I think the big takeaway here is that you want to think about this trade in this is a neutral to slightly bullish trade in general, right? Because as we know, if we're selling a put that's about a 5 delta put on entry, right? Every time we put a trade on, we get long 5 shares of SPY or equivalent to it, right? So as the market is selling off, or if the market is rallying, it doesn't matter. You put on a position, you pick up additional 5 delta in the spiders. So over time, if the market is selling off and you are not closing out your trades at a profit target, but you keep adding more positions, you're getting longer and longer delta. So this is always going to be a net bullish position. That's one of the main things that you want to think about. If the market is selling off and you're not feeling good about the market, does it make sense to continue to pile on more positive delta? You got to ask yourself, right? If you're willing to do so, then it's a good trade. If you don't feel good about the market, you don't want to add any more positive delta because maybe you're holding some iron condors, or maybe you're holding bear traps that you're already, to your eyeballs with long deltas. Do you want to add more long delta? If you don't, then maybe doing this trade is not something that you want to do. So everything has to kind of come together and play together. But if you were just going to do this trade by itself, right? This is a not aggressively bullish position. This is a slightly bullish position. And over time, you will add more and more positive delta. And as market is rallying and you're closing out some of your positions, you're letting go of some of that positive delta. So you get less positive delta on the way up and you get more positive delta on the way down. All right. So I think this is, what I wanted to put out as far as this trade goes. Again, guys, you are able to unmute yourself. If you have a question or if you want to type in the chat, that's fine. I'll spend the next 10, 15 minutes if you guys have any questions, and I will have you on your way. Okay, that's a good one. So spreads versus selling naked. And you know what? We'll do one more thing. We are going to go ahead and we're going to, I need to add a position. I almost forgot about that. We're going to add a put. So, we can go down this list, right? Our target duration is between 80 and 45 DTE. Right now, I am still adding to positions in 21 oct. So 63 DTE is my target. I am looking for, right, today being a Friday, I'm looking for my target credit between $1.25 and $1.50. I don't want my strikes to overlap, meaning if I already have a position in, if I have a position, let's say if I'm short 350 put, I don't want to add another 350 put. I'll just go one lower or one higher. Let me see if I can save. I can save these notes. I think I was able to save this, and now I'm just going to close. So we're going to look. So the 350 is at $1.40. We could go to as high as 353, which is $1.52, or it can go as low as 346, which is $1.25. Maybe I'll go with 348, right, which is $1.33 or so. So I'm going to go and look at, what is it, 348. Let's see what 348 is going for, $1.33. I'm going to sell one. All right, so filled for $1.33. Right now I'm going to go and 348. I'm going to add it here for $1.33. And then what I also do, I set up a GTC to close orders in the brokerage platform to automatically close out if we get to 25 cent debit. I don't really like to set stop losses on GTC. Crazy things happen. Sometimes we get too close to a stop loss. They run stops, market dips, then it rips. And I just, that's not what I want to do. If I know that I'm getting close to a stop, I want to know, what am I doing? Am I going to stop, or am I going to take assignment? Whatever that decision is, if I decided that I'm going to close and not take assignment, then I want to maybe set an alert for that option mid price at a certain point. And once, that alert goes off, I just go in and I manually enter my exit at a stop loss. I don't use GTC or any other conditional orders to get stepped out of this trade. So spreads, right? If I was to, let's say, do a spread, obviously selling, let's say a 350, and then what am I going to buy? I'm going to buy a so we know a Reg T margin will take about $3,400, right? You can probably safely assume that your Reg T margin is going to be about 10% of the notional value. So notional value for this option, right? You can take 350 times 100. So the notional value of this contract is $35,000. Take 10% of that, it's $3,500. You could think about it in a Reg T account. In the Reg T margin, you could assume that your margin requirement to sell a naked put out of the money is going to be about 10% of the notional. So 3,500. Now let's say you don't want to have 3,500 tied up. You only wanted to tie up about $1,000, right? So for $1,000, if we're selling a 350 put, we're going to buy a wing, right? To make our buying power requirement for a spread at $1,000. So here's a trick question for everybody. If you are still paying attention, which put should I buy to make this spread's buying power requirement $1,000? I see 250. I don't think it's right. 335. Well, let's see. I don't think that's right either. So let's see, 335. Right, at 335, your buying power is $1,454. So you have $1,500 worth of buying power requirement minus credit collected, right? So you take $1,500 minus $46, you get $1,454. If you sell it 350 and you buy a 340, right? The difference between the two is 10 points. We multiply 10 by 100. That's $1,000 of buying power requirement, right? It's a 10-point wide spread times 100 shares. That's $1,000 minus $33 credit that we would collect. And you get requirement. Your broker will ask you to put up $967 to collect $33. So now, because we limited our downside, right, that long option pretty much kills all of the premium that we're collecting in the 350 put, right? Instead of collecting $1.40, we're only collecting 33 cents. So how long are we going to hold this put spread for it to decay 80% out of $33? So I don't think spreads make a lot of sense. Now you say, if you say, all right, so where do I need to go in order to collect $1.25 using a spread? Right. So let's say we're going to use a 10-point wide put credit spread, and we're looking to collect $1.25, or let's call it let's round it off to $1.50. Can anybody estimate or guess, where do we sell a 10-point wide put credit spread to collect $1.50? If I had to guess, and I'll tell you how I arrived there, right? So we know we have a 10-point wide put credit spread for $1.50. That means we have about $8.50 worth of risk in a 10-point wide spread, right? We divide 8.5 by 10, we get 0.85. That means that the option we're selling has to have a probability of profit about 85%, which means that this option has a probability of going in the money or expiring in the money about 15%. Now we know that we can use delta to estimate probability of an option expiring in the money, if we're looking for an option that has a probability of expiring in the money around 15%, I would have to guess we would have to go somewhere around either 383 or 382. Now we can take a look and see how close we got. If we sold a 383 and we bought a 373, that's a 10-point wide spread. Right, we don't get the $1.50, we get a $1.08, and that has something to do with the way implied volatility is to the downside. It's not exact science, but we can get pretty close, right? So I know that a 15 delta put, a 10 wide put credit spread will get me close to my target, but not quite. So I would have to go a little bit closer at the money. But if you look at the probability, right? So we sell 383 and we buy a 373, right? Based on current implied volatility, this spread has a 93% probability of expiring out of the money, meaning that you have a 93% probability of collecting and keeping this $107, assuming you're not using any stops. Right? But if we go closer to a 20 delta, maybe we'll go 390, then we buy a 380. Right now we have an implied probability of profit close to 90%, and we get a $1.36 credit with about $864 margin. So a 19 delta isn't enough to collect 150. We go a little higher, so let's say 393. We sell a 393 and we buy a 383. Right, we're at 150, so we get 150 credit with 850 margin, and our implied probability of profit is at about 85%. See how that works out? You get a $150 credit with $850 margin, and you get implied probability of success for this trade at about 85%. But, right, what happened here? We were looking at 348 or something to get a $1.50 using a spread. We're forced to trade much closer at the money, right? Where my naked option had only about a 5% probability of expiring in the money. The 393 put has about a 20% probability of expiring in the money, right? So my potential risk has increased 4 times. Not risk in terms of dollars, but risk of expiring in the money. Right, so I don't necessarily think that spreads is best. I would probably say, trade smaller. And again, but you also have to understand, the risk and the notional value and how many contracts you can hold. If you have a $20,000 account, right? How many naked puts can you sell? Given that it takes about $3,500 per one put to initiate a position, right? So if you have a $25,000 account and the notional value for one put is 35 grand, probably shouldn't do more than 1 or 2 at most. And then you cannot use, right? If you do 2, and let's say your buying power requirement is $7,000, but you have a $25,000 account, right? Of $25,000, 7 will be tied up in 2 naked SPY puts. You have $18,000 of buying power left over. What 99% of people out there will do is go out and put on a bunch of other positions utilizing this buying power, but they don't account for the fact that if S&P goes down 7 to 10% in the next 2 weeks, and implied volatility goes from 20 or whatever it is right now to 35, your buying power is going to explode from 7,000 to probably 15,000. And if you don't account for that, if you used up that buying power to put on a bunch of other positions, which are probably similar to your naked short puts anyways, you put yourself in the position where you're now forced to get stopped out, not because you want to, but because you have to. Plus, your other positions are probably going to be in trouble. You put yourself in the position where you're going to be forced to take on a bunch of losses. And it's not a good, it's not a good place. You don't want to put yourself in that position. So that's why I would say, if you want to be aggressive and you want to use, in a $25,000 account, how much of it can you use to sell these naked puts? I would say a third, right? A third. So 1/3 of the $25,000 is about $8,500. So if one put takes about 3,500, so you have room to do 2.38 positions. Obviously, we can't do 0.38 positions. So it's either you do 2, or if you want to get aggressive, you do 3. And that's it. And that's how you utilize that buying power. I don't think it makes any sense to go any higher than that. It might work today, tomorrow, next week. It might work for 6 months. And you may think, oh man, why am I, sitting on all this buying power? It's not doing anything. But the time when the market goes down 12, 15% in a month, right? Think about maybe it was in April when the market went down like 12% in a week. It'll put you in a very tough spot to come back from. You may not blow up, but you're going to be forced to liquidate your positions at the most horrible time. So as far as spreads go, I probably wouldn't. I wouldn't do it. If I did, I would probably go somewhere where you have about a 10% probability. But then you could get into you go further down into this rabbit hole. And if I do a spread, where's my stop? How many X credit? You'll get stopped out of those credit spreads so quick. I think that the best way to do it is to sell options naked, given that you understand the risks. Naked options decay much faster than any spread because you don't have that long wing, right? You're not spending any of that premium that you collect from the short option to buy protection on the downside. And that long wing is what's going to really hold up that trade. And you'll end up holding for way too long to make way too little. And that's why I don't think that selling a put spread in the same fashion makes sense. If you have any questions, this is the time to either unmute yourself and ask. You can type it in the chat here on Zoom. If nothing else, we'll give it another 2 minutes and we're going to go and see what else is out there. And if there's a way to maybe do some last minute 0 DTE trades for those that are sitting on your hands, looking for something to do. Alrighty then. I guess no one has any questions. All good. I hope that I made this clear. Again, I'm gonna render this down. I'm gonna take away things that I said and try to put it all together into a short video where we cover all of the stuff that we talked about in the last hour. I'm going to post this on the forum. So at any given time in the future, if you want to go back and revisit, and maybe I might have missed something, you'll be able to ask some questions. And I hope that this is going to be a helpful video topic for anybody that is looking to expand their tools that they use. And as always, if you have any questions, feel free to reach out. You can post in the chat. You can hit me up privately if you don't want to ask in the chat. I hope you have a great rest of the day, good weekend, and I'll talk with you next time.